in the equity.
Welcome back,
So
welcome back,
can you tell us a little bit
welcome
about
back,
where and
okay?
when
So,
you choose to jump in and how
this
you
is
think about
great,
these
right?
situations?
I don't know,
Sure.
I think I lost money on this one.
Bank restructurings are unique for a variety of reasons. And so just zooming out for a second, in any corporate
lost 20
restructuring,
bucks.
when we evaluate
My entry
if
was
and where to be
here.
in the capital structure,
Right, apparently.
optionality and
Damn,
the duration
it
or
hit
presumed
the
duration of the
86
bankruptcy
stop loss, right?
is a big
Imagine I
factor
just took
because a lot can
position
change
here.
over a year, 2 years.
Right, or decades.
In some cases, right. And banks
So, yeah.
are different, right? Because you get
This would have been nice.
crystallized, if the bank is seized at a moment in time,
So
and
I'm
you kind
gonna
of get
do
what you get.
exactly
and if you
that if I want to take a trade.
like liquidate any
here.
financial institution, you're probably not going to love the outcome. And so, answering your last question first, it generally doesn't pay to be early in these things because there's a couple really sort of new and interesting dynamics. The first is, the move in the equity price of the bank in and of itself, whether it's because of a rumor, a short, whatever the reason is, that can drive deposit outflow now, which can result in a bank insolvency. And so, predicting that is incredibly difficult. So there's a difference between buying debt
this one is
at
going
the
up.
bank level or at a holding company level, like in Silicon Valley Bank, where you might have other assets.
Little coffee,
and-
guys.
and
Little coffee.
Kind of
Little
other
coffee.
recourse. So they're not all created equal, but the
think this
very
is
long answer to
consolidation.
your question is late rather than early on these things. And so something like Silicon Valley Bank is interesting because there's a variety of assets. There's cash, there's an investment bank, there's a big venture portfolio, and maybe cash. Like there's a dispute over that, and then there's a giant tax asset, and so you can come up with a range of values from $1 to $7+ billion on $7 billion and change of debt.
What's stopping out? Thank God.
There's interesting optionality there. So yeah, we do own some equity. We are in other parts of the capital structure as well.
Right. So, okay, I want to go to Randy now because Marathon very quickly made $30 million in Credit Suisse bonds in the first few days before the takeover. So what are you seeing now, though? Obviously, there was an opportunity then.
Quadruple one.
That investment was pretty unique, and it was. And I've done a number of banking workouts in my career. I mean, a lot of times in the banking investing, they seem overly complicated, and there's tons of boxes and tons of entities you got to work your way through. But in that situation, I mean, it was pretty simple. We zeroed in on one entity that had pretty much all cash on its balance sheet. So it had something like $80 billion between cash and short-term government securities. So it wasn't the type of paper that blew up SIVB. These were short-dated government bonds, so there wasn't any interest rate risk in them, and cash. So we weren't taking a lot of credit risk, and there was like $16 billion of bonds, and they were coming out at 80 cents on the dollar for debt that was due. Literally, we were buying bonds due in 45 days at 20-cent discounts to par on something that we saw very little risk in. So that's what we did there. We zeroed in on that, but I think there's going to be a lot more opportunity to come out of this banking crisis. I mean, the regional banks, and Paul hit on a lot of this, and we've obviously, I mean, everyone in our business is studying this stuff right now. The biggest part of their loan books are these C&I loans, commercial and industrial loans, and they are the funders of real businesses across this country. And if you look across what you're seeing come out of these loan officer surveys that the Federal Reserve puts out, and you listen to what banks are saying, like credit is not flowing anymore out of those banks, right? They're all right now dealing with their own liquidity and managing their own balance sheets. So like that source of capital has just been shut off. So we think it's going to create, we've been calling for a slowdown.
Like
this is
out of the
this is
4
probably
trades,
the
3
thing
of
that's
them
gonna
make money
tip us
and
over
1
into
make
that
lose
real
money. So
economic slowdown.
that was the result.
It's going to be painful, but it's also going to create a lot of opportunity.
Yeah, guys.
And that's a perfect spot. Holly,
Say
what
I'm
are you
newbie,
seeing
I'm
the
still
fallout
learning,
for
popping it up.
companies?
Take care.